Hi everyone, so I thought it would be fun to go through a couple of examples where I made terrible investments. I think most investors would agree that you don't learn a whole lot from your winners, but you learn so much from your losers. And the longer you've been investing, you are bound to have some losers along the way. I'm trying my best not to make silly mistakes, but I'm always going to be learning and evolving as an investor. I have to keep learning and improving, otherwise I'll just keep making mistakes. So to keep evolving, I'm reading books a lot, far more than I did in my 20s. So if you want to get ahead, I really suggest reading the books that I have links for in the description. Look, I've read all of these books at least twice now, and I still get a lot of value from them. These are better than any investing course in my opinion. All right, so let's jump into some bad investments that I have made in the past. I can tell you now, I will make more mistakes over my investing lifetime. I'm going to try my best though to keep them to a minimum, but this one was pretty stupid. But I learned a lot from it, so I don't regret it at all. Plus, I wasn't working with much money, so I didn't have a whole lot to lose. It was also when I had a job, so I could just earn the money back in a few months of work anyway. But look, that doesn't excuse me for being really stupid here. Let me try to explain. It was back in 2010 to 2013 when I was just starting my investing journey. I was just an immature new investor. We all have to start somewhere. Now, I wish I had read the books that I have read now back in 2010, but I guess we all stumble along in those first few years. Anyway, I did at least know that I was just a beginner and looked for an expert to guide me. And I found an Australian investor who had an interesting newsletter that I really enjoyed reading once a week. He was a great writer and is still a great investor. His name is Lance Spicer, and I still think that was a good start in my investing journey because I learned a lot. Now, in this weekly newsletter, I would follow along with his portfolio that he was constructing. A lot of familiar names like Apple, Google, Facebook, MasterCard, Visa, etc. And maybe once or twice a month, he would have a new suggestion to add to the portfolio. Whether he actually invested in these companies himself, I have no idea. And I couldn't invest in every company he suggested as I didn't have the money to do that. So I went for the ones that I thought had the biggest upside potential. And one of these companies was Zicom Group Limited. Zicom essentially is a mining related company based out of Singapore. A lot of their products are for the offshore marine oil and gas operation businesses. Now, the first mistake I made was that the stock price looked optically cheap. Now, what I mean by that is the stock price was about 50 cents at the time. Now, as an immature investor, I thought that a stock that was 50 cents had more potential for some reason than a stock that was worth $300. Let me explain why that was just stupid thinking. Okay, let's say we have company A and they've issued 100 shares out to the world to raise money. They're selling for $300 each. So the market cap would be the 100 shares times $300, which is $30,000. Now the share price now goes up 5%. Well, the stock price goes from $300 to $315. Then there's company B, and they've issued 10,000 shares out to the world to raise money. They're selling them for $3 each. So the market cap is 10,000 times $3, also $30,000. If the share price goes up 5%, well, the stock price now would go from $3 to $3.15. These are exactly the same. So whether the share price is $300 or $3 doesn't matter. Company B just issued far more shares into the world, and that is the only difference. So thinking that 50 cents was cheap because it is a low number is stupid. Now, besides thinking that the stock price looked cheap, I also thought it was a good company because Lance Spicer said it was a good company. I had no idea myself. I was just trusting him fully. Now, I didn't even understand the investing thesis at all either. So it was just a gamble, and I could have got lucky and the stock do really well, or I could have got unlucky and it do poorly. Now, the only good thing that happened here was that when the price fell dramatically after I bought it, I got scared and I sold. The stock has just continued going down and would have made a terrible investment made worse if I just held on to it. But I still took a near 50% loss on this one in a short period of time. So what did I learn? Well, quite a lot when I look back. 1, I need an investing thesis that I can follow. I had no idea how this company was going to improve shareholder value, Were they generating good free cash flow? Were they expanding their operations? Were they buying back shares? I had no idea. I was just following along with a recommended stock. The second point is I didn't look at any of the financial statements. And thirdly, I thought it was cheap because it was 50 cents. And like Peter Lynch would say, if you invest $1 million into a 50-cent stock and it goes to zero, you still lose all your money. So what would I do differently? Well, I'd do a lot of things. I'd create my own investing thesis. I would study the company and make my own decisions. I would look over the financial statements and analyze them. Look, honestly, I pretty much did everything wrong in this investment. So lesson learned, let's move on. So this one is a little different. This isn't a stock. It is an ETF, which is an investing instrument that attempts to give you exposure to a particular investing thesis. This was my own invented investment. No help making this mistake from anybody else. At least this time I had a thesis. Now my thesis was this, that I had been to South Africa, Turkey, Russia, and China over the past few years and saw how different these economies were from what I was used to. There were big divides between the people that were wealthy and the people that were very, very poor. Now, I thought the governments in all these places were an absolute mess. So I thought that it was all just going to blow up and it was only going to take, some sort of credit crisis of some kind to rock the boat here. See, debt levels were really extreme in these places. They still are. Turkey, I thought, was going to default, and South Africa as well, triggering a wave of issues throughout the emerging market world. So that was my thesis. And I wanted to essentially bet against these economies. So I found this instrument which is also leveraged. And the things I didn't think about were this. What were the fees on this highly leveraged ETF? I went back and took a look while preparing this video, and the fees are 1.2%. That is extremely high for an ETF. In comparison, the S&P 500 Vanguard ETF is 0.04%. So this leverage ETF is 30 times more expensive. So that was one big mistake I made, that it was silly of me not to look at the fees. Number two, did I really understand these countries' economies? Well, of course not. I had spent, a few weeks in each country? That's about it. I listened to people in the country complain about their government at the bar. That was my research. And as you can see, I got away with only a small loss here as I came to my senses. The books I was reading at the time really helped me get out of this position. Now, this one wasn't that long ago either, so that makes me feel more like an idiot, but as long as I can learn something from it, it won't be for nothing. And what I learned was this. Firstly, who am I to think I understand how economies work in emerging markets? I am no expert. I don't know what governments are capable of. I also have no idea how the stock markets will react to their governments of those countries. I was just far, far outside my depth of understanding, and I was just purely speculating. I also learned that macroeconomics is a waste of time for me. I am glad some people look at this stuff, but it is too complicated for me to understand. Peter Lynch, he would say, if you spend 14 minutes on macroeconomics in a year, you've wasted 12 minutes. The next thing I learned was I made an emotional decision without doing research or understanding both sides of the investment. Look, just a poor decision based on emotion and fear of bad things happening. I did a lot of things wrong here, but luckily it was a very small bet and something I just never would do again. All right, now with this investment, I still did a lot of things wrong. All these investments are my own fault, which makes the lessons learned stick with me even more. Now, I actually also had a thesis with this one. I am from a farm in Australia, and I can see how important Australian food products were to feed the big populations in Asia. Nearly everything that Australia was producing was going to Asia. So Rural Funds Group is a real estate investment trust where the company owns a lot of different farming lands throughout Australia and New Zealand and leases the property out to farmers. They had almond, avocado, beef, chicken, and a few other different industries. They also owned water licenses, which I knew were a very, very valuable asset. See, water licenses are like a royalty for a song. Every year, as people use water for their farms, Rural Funds Group would collect a fee as they own the rights to that water. And a lot of these farms, especially those almond farms, they need a lot of water. So I like the idea of having a stable asset base like this in my portfolio. So I spent some time accumulating shares in this company. I was hoping it would be a big part of my portfolio, but all of a sudden, the stock price dropped 30% in a day. See, a report came out from a company in Hong Kong, I think, that said that Rural Funds Group had too much debt and won't be able to make their repayments. Look, it was actually just a short selling company that had a big short position against them. Now, I had no idea if this was fact or fiction, and I got scared and I sold about half my investment near the bottom. Later, I sold the rest at a little above the price I paid. Look, but overall, including the dividends, I think I took a slight loss. So what did I do wrong here? Well, so many things. I was emotional again. And the only reason I was emotional was because I didn't understand the investment well enough. If I knew the investment better, I could have made a better decision about whether the news story was full of hot air or actually had some substance. I had no clear thesis on what the stock should be worth. I had a thesis, but not on its price. It would have not been too difficult to add up the value of all the farmland plus the free cash flow the company was receiving each year, and then I could have relatively easily valued the business. I could have then worked out the growth rate as the company was buying more farmland and could have projected out a future stock price. But look, I didn't do any of that. I didn't bother going through the financial statements either, and I needed to look at the assets and the debt. Look, maybe the debt was too high. I had no idea. If I did do this, I would have seen the company did have a lot of debt, but they also had a lot of A-grade assets, and I just would have been more informed. If you've been watching my videos for a while now, you will see how I now analyze a company. I look at the industry they are in. I look at the growth prospects. I look at the competitive advantages they have and how durable they will be. I look at the management team. I look at the financial metrics like debt and return on invested capital, gross margins, book value, revenue, all those sorts of things. I also make sure I understand the value of the business and then I pay a price below that value. I also look at individual companies only, so no more macroeconomic gambling with leveraged ETFs. I also put together a thesis and then a negative thesis to understand the things that might go wrong. That way, I know if something has changed, well then maybe I should sell. I also have a near 60-point checklist to make sure I haven't missed anything. And I keep reading to learn more things and studying the best investors like Mohnish Pabrai, Warren Buffett, Peter Lynch, Guy Spear. And I guess I'm just trying to be a little less stupid every day. Now, I guess I'm making this video to be a little bit selfish here because I really just wanted to relive my stupid mistakes so I could learn from them. But I guess I hope you can learn something from me sharing these mistakes, and there is no need for you to make the same ones. So my advice would be to have a look over your portfolio and think about each investment. Because like what happened to Rural Funds Group, a crazy event will probably happen at some point, and I hope you are mentally prepared for that. Now, I hope you subscribe so you don't miss my future videos. I would also love some feedback, so don't be shy and hit me up in the comments. Now, don't forget about the books in the description below as well if you're trying to learn more, and I will see you in the next video.